Let me ask you something. What if your biggest monthly expense, your mortgage, could actually become your biggest wealth building tool? That's exactly what the Smith maneuver was designed to do. And today I'm going to show you how the numbers play out using the actual Smith maneuver calculator. You'll see the borrowing cycle, the investment growth, the tax benefits, and the total long-term impact that this could have for someone in your position. The Smith maneuver is a Canadian tax strategy that slowly converts your non-deductible mortgage interest into deductible investment interest. As you pay down your mortgage, your readvanceable line of credit increases and you borrow that amount back to invest. Over time, that builds an investment portfolio, creates potential tax deductions, and makes your mortgage more efficient. Now, this is an important note. This video is not the full explanation of the Smith maneuver. If you do want the complete breakdown of how that strategy works, the rules behind it, and its different components, make sure to check out my previous video. That one dives deep into the full strategy. This video is strictly a calculator walkthrough, and before we get into the numbers, a quick disclaimer. This video is for educational purposes only. This Smith maneuver involves real risks, and everyone's financial situation is different. This is not financial, tax, legal, or investment advice. Please connect with the appropriate professionals from mortgage brokers, accountants, and financial advisors before acting on any of this. All right, let's get into the calculator. I'm going to walk you through it step by step so you can see exactly how the borrowing works, how the investment side grows, and what the long-term projections look like, and how all of the moving pieces come together. All right, here is the Smith maneuver calculator, and we are going to do a scenario for Fred Jones and his family. Just a few overviews of Fred Jones. He's a salaried employee. He owns one rental property. He has some mutual funds, and he makes monthly contributions to those. We are going to take a look at how fast he can debt convert his mortgage over to a tax deductible loan, and then his total net wealth benefit for implementing the Smith maneuver. So starting us off with household income. Fred and his family, they have a household income of $150,000. They have no investment income, no pension income, but they do have that rental property that I mentioned. It makes $36,000 per year. Now, of that $36,000, Fred doesn't use any of the current money for living expenses. Basically, all the money that he gets, he's currently just sitting on it. The rental expenses are $34,000 for this property. This is going to become really important as we get into the results page, but for now, just know that Fred earns these funds and then has the expenses on that property as well. As I said, he doesn't have any self-employed income. He's not a business owner, so nothing to include in here. Quickly touching on those assets, he did have the mutual funds of $30,000. These are non-registered funds, which is important for the Smith maneuver. Things like RSPs and TFSAs are not eligible, and so we are only looking at non-registered values in this case. And then we're just going to throw the value of that rental property, even though it's not going to have a huge dent on or won't have any effect on the results that we'll see in the calculator. And then we're going to throw in $10,000 for their emergency fund. If we were doing a scenario where we wanted to pay off debt and we needed to do a certain isolation, we would include liabilities to see if there's the opportunity to improve monthly cash flow. For Fred, because he doesn't have any large visas or lines of credit, we don't need to dig too deeply into his liabilities. A quick note on marginal tax rate. The calculator generates a general marginal tax rate, but depending on which province you live in, it's going to change. And so we just need to get a specific marginal tax rate depending on the province that you live in. All right, next we're touching on the mortgage information. Fred has a $750,000 property. That would be the value of the home if he sold it today. The mortgage balance is $450,000. Interest rate, 4.24%. Amortization, right where it needs to be at 25 years. this generates a monthly payment of $2,426. Next is the readvanceable line of credit. Incredibly important for the Smith maneuver that as we make our principal payments, there is an amount that starts to readvance in the home equity line of credit that's available and accessible to us as we need. So the Bank of Canada prime rate. Now I'm going to slightly adjust what the calculator shows here. Most lenders do not base their prime rate on exactly what the Bank of Canada is offering. They typically have a much higher prime rate. And so at most lenders today is November 14th, 2025, the prime rate at most lenders is 4.45%. And usually they're going to offer a discount or an addition on top of the prime rate. For most lenders, for the home equity line of credit, it's going to be 0.5%. So this is going to give Fred a total interest rate on his home equity line of credit today of 4.95%. All right, now let's take a look at our investment assumption. And as we go through, you're going to start to see the benefits of the Smith maneuver start to populate on the right-hand side here. So on our assumptions that we're making for this client, we are assuming that we can earn an 8% return on the market. The 850, that's the amount that's readvancing into the home equity line of credit. Fred wants to use that full 850 to get invested in the market. And here's where we start to see the benefits of doing the Smith maneuver. And the last button that we can click here, and this is where we're actually going to see an amortization improvement, is whether or not we want to use the tax savings in order to pay down our mortgage faster. So it is recommended with this because we do want to get rid of our non-deductible debt as fast as possible. And now we've shaved off 3.33 years from paying the loan. We mentioned that Fred has mutual funds. Now, in consultation with his financial advisor, we determine whether or not these are fairly liquid, whether they can be sold, whether there's implications for that. But let's say we get the green light to sell the $30,000 worth of mutual funds, pay down Fred's primary residence mortgage, and then re-borrow them to go back into those mutual funds. Again, we see this jump in amortization improvement, and our overall value of the Smith maneuver increases. All right, moving through, we had that emergency cash. Now, Fred didn't want to take all of his emergency cash and use this, but how we kind of can chat with clients about this is you are able to take your $10,000 of emergency cash and use that to go towards your mortgage balance. And because you're in a readvanceable mortgage, those funds are still available to you in the home equity line of credit. In Fred's case, he was okay with that, but not the full amount. He just wanted to do $5,000. So again, we see that amortization improvement. We're now at 6.5 years saved of paying down the loan. Now, if you remember, Fred had $30,000 in mutual funds. He achieved that by making a monthly contribution of $300. Now, instead of directly investing into the mutual funds, we are now going to push that $300 first through his home. And again, we see another improvement here. The last thing that we're going to touch on is Fred's rental property. The cash flow dam accelerator, or rental cash damming, as some of you might be aware, is a super powerful strategy. And so by clicking this off, we're going to see a massive benefit because every month we're going to be pushing through an extra $3,000 against that primary residence mortgage, and it's going to really help Fred pay off the mortgage faster and see the benefit of rental cash damming. And so quickly just looking at our benefit sheet from Fred's perspective, from a taxation improvement, total tax deductions over the amortization period, $483,195. Total tax savings using the Smith maneuver, he's going to get $196,660 back. Amortization period, his original amortization was 25 years. We've now shortened that to 6.67. Net wealth improvement, Fred's family net wealth improvement goes up to $1.3 million. And the reason that we have the second net value of the Smith maneuver is that we do have to factor in that Fred was investing prior to the Smith maneuver. He had that $30,000 of mutual funds. He was investing $300 a month. And so we have to include that in our calculation if we're comparing apples to apples. So his current plan would have netted him $505,513. His existing plan with the Smith maneuver is 1.3. So the net value of doing the Smith maneuver, $840,118. If you enjoyed this calculator walkthrough and are looking for more information or are hoping to have your very own scenario ran for you through the Smith Maneuver calculator, feel free to book a time in the description below for us to connect. If you enjoyed this video on wealth building, you're gonna love this video as well.